Welcome to Second Take, the show that focuses on the issues behind the news. The gold price topped $1,000 an ounce earlier this month, with analysts forecasting that the price will trend higher over the years. Mining Weekly editor Martin Creamer is with me in the studio today to tell us more. Welcome to Second Take, Martin.
Hi, Shannon.
Why is a gold price of $1,000 an ounce so significant?
It's a magical level. You know, it's the sort of level that people have been forecasting now for some time. You know, you find most of the gold miners have been saying that we're going to trend towards $1,000 an ounce. And now it has happened, and that has created quite a lot of applause. And it's also created some forecasts that indicate that it should continue to trend higher for some time.
Now, while a higher gold price is good, what does it mean for South Africa's poor production position coupled with a low rand gold price?
Firstly, production, the mines have been struggling to get their production up unsuccessfully because of the new safety regime, where mines close if there's any safety hazard, and they sometimes close for quite a period of time. And also, you know, the whole productivity scene in South Africa is impacted by going deeper and deeper. So to actually lift your production is quite an effort. And I think that possibly the worst could be behind us, but you know, we've had a labour unrest, and we've had a few other issues that have set us back. Hopefully that will now be behind the country and we can look for a higher production level. But then the second issue is the strong local currency. And although we celebrate the dollar price at $1,000 an ounce, we lament the rand gold price because we see that the margins become squeezed as the rand value lifts, and it has been strengthening to a point that wasn't anticipated. And the big MTN deal, of course, with you know, the prospect of rands being bought, has strengthened that particular position of the rand, and it is upsetting for exporters, particularly gold miners, and they are having to, you know, cut their cloth rather than expand or rejoice.
Mine production peaked in 2001, gold mine production.
Yeah.
But this is expected to continue to decrease.
Yeah.
What effect will this have possibly on the gold price?
You see, there's a school of thought, particularly coming through from the American precious metals, that the fundamentals don't affect gold. You know, that's their argument. I think Jeffrey Nichols says, look, don't look at supply and demand fundamentals. You must remember that gold is a monetary asset. But that is just one view. I think that, you know, obviously if there's less supply, it should push the gold price up. So one should expect a higher gold price from the lower production.
And now, do you think we can expect to see an increase in the number of new mines owing to a higher gold price?
You should. You know, it should automatically follow. But exploration has been slack. You know, people have cut back on their exploration. They're keen on doing near mine exploration because it doesn't cost that much. But going into the frontier is something that doesn't quite appeal to many of them. And so you have a backlog when it comes to new mine input. So one would say that in theory, you know, the higher gold price should boost new mine discovery. But there is a lag. There's always a long time lag, and there has been a cutback in expenditure on exploration. So one would say, you know, it's not going to happen very quickly. And if we look at the supply-demand fundamentals and say, look, that does have an impact on the gold price, then it should help the gold price to lift. But as I say, there's schools of thought which says, you know, the biggest factors at the moment are the fact that real interest rates are going negative. You know, real interest rates are again negative, and if history is a guide, that normally means that the gold price rises. So again, that emphasizes the position of gold as a monetary asset. And then we had also Investec coming out and saying that, you know, they would rather advocate people investing in mining equities rather than exchange-traded funds. And that is very good for our local mines, because there has been a tendency for people to say, we want to invest in the physical gold. So they've been going into exchange-traded funds so that they get access to that physical gold. But that's pretty expensive now because, you know, the price has risen to an extent where, do you want to go into physical gold, or do you want to rather go into a mining equity which gives you access to a mine that's still in the ground, but you know, some of those ounces in the ground are very low cost. You know, we saw that some of the resource ounces are bit of a dripping roast. They're very low. So there is a possibility that equities might be better investment than exchange-traded funds, and we like to hear that in South Africa because then it promotes investment in our mining industry.
Thank you so much for your time, Martin.
Great. Thanks very much, Shannon.
Pleasure. That's the show for today. Join us again next time for more insights into the happenings of the mining world.